evening and a very warm welcome to the update call on the Edelweiss US Technology Fund. This is Varun Sanan from Edelweiss. The change in taxation on international funds has actually made investing in them very, very attractive now. With the taxation being at parity with Indian equities, now investors are going to view international investing in terms of their long-term return prospects and also the case for diversification. There are multiple geographies and themes that investors in India can invest in. They can invest in Europe, emerging markets, China, and the US. But there's one particular theme that we feel has the potential to outpace the broad spectrum. It is also the theme that has return potential of a different magnitude and is very transformative in nature, which is the Edelweiss US Technology Fund. We also know that US equities and global equities have had a bout of volatility in the past week or so. There's been some weakness in terms of the employment data coming out of the US. There's a slowdown in growth that has been reported, and the manufacturing data has looked a little weak. Now, all of this actually gives investors kind of an entry point to invest in US tech stocks, which have had a fantastic run over the last 18 months. Now, this volatility is also, followed by the Fed's decision to pause on rates and not cut rates like a lot of people were thinking about. The big question here is Fed leaving it too late to cut interest rates? We want to answer a lot of those questions, but we want to predominantly answer questions around the long-term growth prospects of US technology companies. I'm glad to have with me Joe Wilson, who's the portfolio manager for the JP Morgan US Tech Fund. Incidentally, the Edelweiss US Technology Fund feeds into the JP Morgan US Tech Fund. Welcome, Joe, and glad to have you on the call with us.
Yeah, thank you for having me.
Joe, let's start with a bit of a fundamental question here. You've been in markets long enough. You've experienced multiple tech cycles. We are witnessing a kind of a sell-off in US large cap tech names. What is your perspective on the situation that we have on hand today?
Hi, so great question, good area to start. In the last almost month, call it July 10th until today, we've seen the S&P sell off around 8-ish%. The Qs, which is predominantly very tech heavy, is down 13.5%. So everything is, broadly speaking,
Qs is NASDAQ. Sorry to interrupt you. Qs is NASDAQ.
Right. Yeah. Qs is NASDAQ. Yes. So broadly speaking, the markets are down. Tech is down more because it's also been one of the hottest areas within the last 18 months of investing. What's driving it really, I think, is some of the rate decisions and perspectives in the market that are saying maybe the Fed has waited too long to be more lenient on the rate environment. I think that has also encouraged, some action that is maybe not as obvious or evident from just looking at S&P or the Qs, which is a very strong relative move within smaller and mid cap stocks as well, too, relative to the larger mega cap stocks. And that's happening also very broadly across every single industry. Mostly, we're starting to see that in whether it's in financials or in industrials, healthcare, but also starting to see it in tech as well. I would say that one measure that I've often looked at over the last 20 years is the relative performance of the NASDAQ versus the S&P. And when you get, on average, every 2 years, you have something like this, whether it's a Fed discussion or it's currency fluctuations on a global basis or potentially a war. You find an excuse to sell things that have worked. Tech has been something that has worked over many, many decades. And so there's this on average, every 2 years, there's about a 7% sell-off in the NASDAQ versus the S&P 500. We're at about 5.5%, 6%. So it kind of feels like we're very close to that average sell-off that we get every 2 years. Now, we're also coming out of a very volatile period with COVID. So we could see more of these or more frequent, but I think it's a very healthy mechanism in the market to have some skepticism or have some fear, because if we're all exuberance, you're going to feel like you've missed this every time. And to your point on opening this up, that's why this is such an attractive opportunity, I think, for investors who are thinking a little bit longer term, beyond just a few weeks or a few months.
Great. I think, most investors that I've interacted with are actually thinking very, very long term. But the other fundamental question that we're getting from a lot of investors is that the last 18 months have been driven by predominantly returns coming from the Mag 7. Our portfolio, how does that play these 7 stocks, and how are we looking at few of these interesting ideas within the Mag 7 space?
Yeah, so as you know, I think last year was very much characterized by the Mag 7 performance and a very narrow market. I think it's important to point out that I think it was between 65 and 75% of absolute performance for the NASDAQ, the S&P, passive ETFs like XLK. 65 to 75% of their performance came from the Mag 7 last year. In 2023, our portfolio, our fund, beat all of those indexes, and we finished near the top relative to our peers. But we did that only with 33% of our absolute performance coming from the Mag 7. So we're much more diversified. The largest holding that we have at any given time is around 6% on an absolute basis and 5% on a net basis. And so we did better, but we took a more scenic route last year. And our portfolio, the dynamic of it hasn't changed that dramatically from the end of last year to this year. I would say we follow a very, not mechanistic, but we follow a valuation. We're sensitive to valuations. When we look at companies, we invest with them thinking about what the risk reward is over the long term. But we acknowledge also that the market can hit these short-term points in time of exuberance or fear, right? And so, for example, NVIDIA has been one of our largest net sells year to date. And that's not because we don't like the company or we don't believe in AI. It's just because the market essentially reduced the risk reward favorability for us. And so it wasn't as favorable of an investment as companies like Guidewire or Manhattan Software as well, too. So we're much more diversified. Our top 10 holdings are around 32 to 33% of the total portfolio. If you compare that to the QQQ, for example, it's 50%, and in the top 10 holdings. And then in the top 3 holdings, you're almost at 30%. And so we're trying to take, a very exact approach to our secular bets. We don't want to own the companies at the top just because they're big and they're leaders. We want to identify those companies that are leaders before anybody else does, just like we did with NVIDIA in 2016 when it was our largest position, or Tesla in 2019. That's how we generate a lot of alphas before everybody thinks, oh, this is obviously the leader in AI, or this is the leader in EVs or autonomous vehicles. We own that company in a big way that's going to drive a significant amount of performance as others recognize that.
So just to follow up on that, because you made a very interesting point. When I looked at the portfolios, and I've been tracking this fund for quite a bit of time. In 2016, NVIDIA was your top holding, or one of your top holdings, and it wasn't a large part of NASDAQ. In fact, in 2020, Tesla was one of your top holdings that wasn't even part of NASDAQ. So how's the identification for a lot of these businesses that you feel are going to be the compounders for tomorrow? How do you go about doing that?
Yeah, we have, we sit in a wonderful company that has access to any company that we want to. And we have resources that gives us abilities to talk to experts and talk to developers. Our own IT budget at JP Morgan is, around $15 billion. So that gives us a data point in terms of like what a sophisticated enterprise is spending on as well. And so it's a mosaic approach, but I think a lot of other peers have that as well. The reason that we've led in terms of returns and why we have, a 20% 10-year compounded annual return is because of the people on the team, and we all have these characteristics that make us different from that make us different relative to our peers. And I think the three characteristics that really drive us and separate us is the fact that we're all extremely curious. And so we have this like innate desire to learn, how technology works, how it disrupts the world. And can be very specific. And so NVIDIA, for example, is a name that we found because I had just bought Alexa, from Amazon, the Echo device. And I bought that in 2015. And my son, he was 3 years old at the time, he asked it a question and Alexa gave him an answer. And I remember thinking, Siri hasn't been able to understand anything I've asked it on Apple for like 5 years. What's going on? Like, how did Amazon within 1 year catch up? And so we started doing work and trying to understand like what Amazon that was doing different. And it turns out there was a white paper that we read that talked about them using natural language processing, using GPUs for deep learning. So using the resources of JP Morgan, we call up Google and we said, hey, Google, do you have anybody that knows anything about AI? And they said, sure. And they sent us a person by the name of Credo, who was a co-founder of Google Brain. And he came in and this is late 2015. He says, computers can now see and hear at a human level for the first time in history. And he took this dramatic pause and he looked around the room and he said, think about that. So that's what we've been doing since, 2015. That's what encouraged us to build up a significant position in NVIDIA in 2016. It's what encouraged us to go and talk to Tesla and ask them 3 times to meet with the head of autonomy before any investors met with them one time. And so that formed our opinions on these companies, is like understanding these dramatic shifts. They don't occur often, right? I think it's on slide 6. We talk about we show that the leadership of platforms and technology changes about every decade, right? As we went from mainframe to PC to internet to mobile cloud. We've been using this slide for 6 years, and with the artificial intelligence label at the top defining this next platform shift. This isn't metaverse, this isn't cryptocurrency. This is infrastructure change. Data centers are changing. And we call it AI, but it's really accelerated compute, right? So we're no longer reliant on CPUs in the data center. Our focus is on GPUs. This carries the investment opportunity, not just for that 2016 period to 2020 when we made a lot of money in NVIDIA. This carries our investment opportunity, having this domain expertise for the next decade. So I don't want to be an AI fund because we're going to capture the platform that comes after AI. We have many different secular opportunities that we invest behind, but AI and accelerate compute will define technology for the next decade. And that's something we have very high conviction in.
Sure. So that takes my mind back to, the early 90s, where hardware guys like Intel, HP, IBM were doing very, very well. And what preceded was the software companies started monetizing that hardware. And that's where you saw huge growth for some of these software companies, and their stock prices rocketed. So do you feel that a similar trend would follow in AI, that today it's NVIDIA or the guys who are making those semiconductors, and the next leg is going to be driven by somebody completely different?
I think I think we'll see something like that. It might not follow the same exact way, in the same path, but I think that's what we'll see, right? Today, it's obvious that we have an extreme shortage. You know, there's a tremendous demand and not enough supply for the infrastructure, the actual hardware, the atoms that drive AI capabilities, that drives training and drives inferencing. That will play out, I think, over the next 3-4 years, right? And what we're very attracted to within semiconductors and hardware is that we haven't seen a lot of investment there on the private side or VC side for over a decade. It's all gone towards software and this belief, you know, the Andreessen belief of like software is going to eat the world. Software ate the world. And in the meantime, we underinvested in the global expertise of semiconductor manufacturing and semiconductor specialty. And that industry has also gone through some very difficult periods. Coming out of 2000, every semiconductor company owned a fab, and now nobody owns a fab because we go to TSM or Global Foundries, or in some cases Intel. Not much Intel yet, but the point is that the semiconductor industry has really found their specialty. It's consolidated, and it's a great area for investment. But that doesn't guarantee that it's going to be a great area for investment in 3 years or 4 years or 5 years, right? Competition is increasing within accelerated compute. Today it's NVIDIA, but you also have massive investments coming from Microsoft, Meta, Amazon, Alphabet, all investing in their own silicon, so they don't have to be beholden to NVIDIA's GPUs and supply capability in the future. Now, it's NVIDIA's goal to make sure that those ASICs, those internal silicon devices being made by hyperscalers, don't overwhelm the market, right? And so NVIDIA has to move very quickly. But there's most likely a use case that we'll find for all hyperscalers where that silicon takes a significant amount of share. So we have to be sensitive to that. We also have to be sensitive to that every software company up until about 18 months ago was a cloud company, a SaaS company, and it was specializing in, you know, maybe a healthcare service or a software service that provided to the healthcare industry, or a generalized software like ERP or CRM. But they didn't have AI capabilities or AI tools then either. So what we're looking for is to see which of these software companies will cross the chasm, become sophisticated AI application vendors. And then we're also monitoring closely emerging software companies, those companies that are just being formed in the last, call it, 12 months, that are AI first. They're brand new. They have a very different view on how to use AI. And they also have a very different motivation. They can move much faster. Maybe it's smaller teams, and they're more specialized. But we'll see that transition over to software as well. I think in the meantime, what we're seeing is a few companies that are able to harness it. Adobe is doing a great job of innovating within software. But to get any of this to work, and we know this from our internal discussions with JP Morgan, there's a lot of infrastructure tools that also need to be used. And that's software that comes from companies like Snowflake or Elastic, MongoDB, Datadog. Those are our software investments today. I think that's a better bet. And then we'll find more of the applications, I think, in the future. Oh, by the way, this opens the door. This opens the door to many other capabilities, like robotics married with AI. And those are things like, that's something I'm really excited about. But that's another, maybe call it year, 2 years, 3 years out. But those are things that we're focused on.
So let's dive a little deeper here. You've given us a few companies. Let's take one of them and figure it out of how this journey is going to be, and what is there in terms of how the portfolio reacts to some of these names and builds over a period of time, so that it translates into real returns.
Yeah. Do you have a company, or you want me to talk about a company?
Go for it. Pick your best bet.
Yeah. So look, I think the opportunity for an active manager today isn't to identify the sustainability characteristics of NVIDIA or Alphabet, for example. It's to find those other opportunities that can be 10xers. And one of my favorite companies, a company we have large overweight in, is Credo, which is a company that makes active electrical cables, networking, semiconductors, essentially, that help drive faster speeds and feeds for AI training within a data center, right? And so our premise here, our view is that when we move from x86 to AI data centers, that's very good for NVIDIA. But what happens within the data center, especially a hyperscale data center, is it creates massive bottlenecks. Now you have this super performant server, but you now have bottlenecks on getting data to that server and getting data out of memory. And so we own companies that have been investing in relieving these bottlenecks for 10 years or 20 years. And one of these companies is Credo. And they've designed an active electrical cable. They've designed a networking chip that allows for low-cost, high-speed delivery of data from a storage server to an AI server. It could be an x86 server, and that's where they started. But their solution is much more important because the number of networking connections in an AI data center goes up 10x. And it requires much more speed. And speed, if you're not using an AEC, is very expensive and very complex. That's why we love Credo. So they started with Microsoft. Microsoft is a huge customer for them, just in Azure data centers, vanilla x86. And now they're starting to capture AI workloads within Microsoft and Amazon and having discussions with Meta and Alphabet. But this is a company that is very good at serving hyperscalers. We bought the stock. I think it was around $12 a year and a half ago. It was Valentine's Day in the U.S., February 14th, a few weeks after we started buying it, and Microsoft had to pause a data center build. And the revenue disappointed that quarter. They pre-announced. The stock was down 50% the next day. So we were buying it. We were buying more because we had so much expertise and understanding of what this company was achieving. We bought more at $7 and $8. This was when it was a sub-billion-dollar company. And that feels like a scary thing, kind of like this environment that we just went through in the last week, which feels kind of scary. But when you have conviction and you have valuation and you have an understanding for baseline or worst case scenarios, that's what gives you conviction to buy it. So we bought a lot more of it, and the stock's now, it was at $30, now it's at $24. I think there's still a lot of opportunity ahead with it. Oh, and by the way, these are companies that when you start working with hyperscalers early on, you build up more expertise, which means that you start gaining an idea of like what they're going to need, not just for their next data center, but the data centers are going to build in 1 year or 2 years. And so these, what becomes a customer becomes a partner, essentially, because you're helping design for them the relief valve for any of their bottlenecks, and they work very closely with you. And so these are things that typically compound over time, especially these companies that are very focused on just a handful of customers in a big way.
So what you're saying is that as AI increases, usage of AI increases, the guys who are providing AI infrastructure are also going to be big beneficiaries. And so I read this very interesting quote that now hyperscalers use 4x, 5x power than what they were using about a couple of years back. Now, that makes me think that probably some of these guys who are providing infrastructure to hyperscaler or making them more efficient are going to be the things or businesses of tomorrow. Very interesting. Now let's come back to a question that's at everyone's forefront in terms of valuations for some of these AI companies and the runway of growth. How are we seeing all of that playing out? Because it's great at valuations which are not at these levels, but once valuations reach a level like this, how do you capture returns going forward?
Um, so that's a great question. I think it's also, to put, I think to paint a broad picture that tech is expensive mischaracterizes where we are in tech today. I think there's some segments that are more expensive than others. Semiconductors is a great example where we have valuations that are trading near, previous highs. But if I were to tell you that NVIDIA on next year's numbers is only trading at 29 times earnings, I don't think most people would say that's really expensive for maybe one of the most important companies in the world. But we have to look at forward numbers. And NVIDIA is only one company. If we look at other semis, there's some higher valuations. But you pay a higher valuation for higher growth. What you have to get right is the sustainability of that growth and the magnitude of that growth. And so if you look at on slide 17, we show, CapEx over the last decade. This is the amount of money that companies like Microsoft or Google or Amazon or Meta spend every year, right? And so just 10 years ago, we were spending, a little over $20 billion for those top 5 companies that I just mentioned in their capital expenditures, building data centers, buying servers. Fast forward to today, 2024, we're going to spend close to 200 billion. So up 10x. What we know about AI, Mark Zuckerberg told us this the other day, just going from Llama 3 to Llama 4 requires 10x the amount of compute. It doesn't necessarily mean 10x the number of GPUs. It's just 10x the amount of compute. And so as Jensen makes, more capable GPUs, maybe we need, 3 or 4x the number of GPUs to train Llama 4, right? So which gets us to 10x the amount of compute. That's just for next year when Llama 4 is supposed to be complete its training. So we're going to go from 200 billion, I think this year, to close to $1 trillion within the next 5 to 10 years. That the conversations that we have with large language model, foundational model companies gives us a lot of confidence that CapEx will continue to increase at a sustainable pace of near 20%. That gets us to $1 trillion 5 to 10 years from now. That is what makes us feel a lot better about paying it what is perceived to be an expensive valuation today or expensive multiple for some of these semiconductor companies, because in 2 years, it's going to look really cheap. We'll look back and we'll say, why wasn't I buying it then? Why did I think it looked expensive? I think a lot of along the way of investing in NVIDIA, trust me, because we've had such enormous returns in it, there's been many points in time where I have conversations with industry peers. It's like, why would you pay, 60 times earnings or 10 times sales for a semiconductor company? And it's like, well, the reality is you're not, if you just move forward 1 year or 2 years. And so that's within semis. Within software, I think it's the exact opposite. We're seeing valuation at levels that are below the average of even pre-COVID. So not even including the huge run-up, just, pre 2020. And the reason there is because there's a lot more growth, less profitability, and these were seen as the longer duration assets. This is everything that you wanted to stay completely away from in 2022 when tech got, torn in half essentially. And the market still hasn't come back to them. Right? So you have companies like, we don't own it in the portfolio, but Zoom is trading at, a little over 2 times sales. And it has, probably around 10% growth. So this is a group of companies that we're following, but I think there's a lot of opportunities there to identify those ones that do have the sustainable characteristics. What we want to do is not be too early in buying those, but appreciate those when we think the market's going to start to respond to better numbers. And I think that's coming, right? Like the Fed's dropping rates. You can't unsee a lot of the data that we've seen. So we're feeling more comfortable about maybe adding more risk or buying these longer duration assets. At the same time, all these companies that within software that have felt this significant pain have also reduced their headcounts dramatically. So they're much more profitable. What we perceive to be long duration is actually now mid or short duration. And so the income statement, the balance sheet looks a lot better. I think that's a great opportunity for us. And that's what we're specialized in.
In fact, I think you're preempting my questions. I was going to come to that question right after this one, but let's move to something a little more futuristic. So we've seen that the portfolio's got a lot of AI companies. The portfolio's got allocation to software companies as well. But let's talk about there are issues that the world is grappling with in terms of climate change or healthcare, etc. And the more we move forward, it clearly looks like that tech will help solve some of these problems that we've been looking answers for a considerable period of time. Give us some sense around, do we have companies in the portfolio that are somewhere tuned to finding solutions for these problems, or we're really early in that ecosystem right now?
Yeah, so like more of the tech, not for tech type of opportunities. Yeah. I think that's a great question, and that's something that we have definitely leveraged. So we are not constrained in our ability to go outside of tech to find companies. Tesla is a great one, which is not categorized by Russell or S&P as a tech company. It's classified as consumer or industrial by other indexes. So a lot of our peers are not able to leverage their skill set and saying, "Hey, that's a tech company," hiding in under the clothes of an auto company, for example. So we own Tesla. We've owned companies like Dexcom in the past as well, which does continuous glucose monitoring. We've owned Enphase, which sells inverters for solar. Today we own First Solar, which I think is the largest U.S. manufacturer of solar panels and has a great runway ahead. But the areas that we're looking at within other segments that I think are really interesting are within robotic surgery, which is a few names that we have been looking at. We don't own today. And then also on the power generation side, because right now, while tech will help, I think, solve many of these problems, especially like think of something like robotic surgery now. Intuitive Surgical selling Da Vinci 5, which is way over spec, but it's over spec so it can collect all this data and then train the robots how to perform more generalized surgeries. That's really exciting. But right now, tech right now is causing a major problem for power, right? An AI data center has 10x the amount of power going to it. It requires 10x the amount of power. So we've usually been building data centers with 5 to 10 megawatts of power requirement. We're now speccing them out at 50 to 100 megawatts. And Amazon just bought a third of essentially of a nuclear power plant, Talon Energy, in the Northeast US. All because they have a gigawatt data center in mind in the future to train these massive language models. But the relief for that isn't going to be solar and batteries. It's not going to be Tesla and First Solar. Those are going to be offsets. The U.S. needs to find, and globally, we need to find ways to build out different power sources, clean power sources. So we're doing a lot of work on the nuclear side as well, too. So there's some emerging companies, private, but also some public, that have a skill set there in the U.S. And those are names that we're also looking at. And I think that within our within what we own today, we own companies like Monolithic Power and Vicor, Supermicro, which is very focused on liquid cooling of data centers. Monolithic Power and Vicor make essentially inverters for AI servers, so it makes the power delivery much more efficient to each board and each GPU, and the CPUs and the accelerators that accompany it. But we see like I said before, a broad opportunity set. Maybe one of the most exciting is on the robotics side, where we've spent a lot of time. Even going to the Northeast, Carnegie Mellon is known for their robotics expertise. So we go there, we spend a day, we learn a lot about the opportunity set. We own a company by the name of Teradyne, which owns Universal Robotics. Think of these as less humanoid, but more industrial, that work in warehouses and helps relieve some labor shortages that we have on a global basis. But Tesla, with their very human-looking robot, I think is really exciting. And I don't think people understand how big of an opportunity this is, right? Like in the US, we've talked for years about onshoring, for example. But even if we were to onshore manufacturing, we don't have the labor set. So we're going to have to rely on robotics married with AI. And I think this becomes more obvious when people actually see the Tesla robots working in a Tesla factory, whether that's putting on a driver's side door or putting batteries into the battery tray. Like, it's going to be those just simple things where people are going to go, oh, I'll start ascribing value to these companies. But AI will change the world. It will change every single industry. That's why it's so important for us to have that flexibility to be able to go outside of tech when we see companies that are innovating at a very rapid pace.
Listening to you feels like you're giving me a trailer on a sci-fi movie. But having said that, how do you feel about some of the large giant cap tech companies that are probably lagging behind in terms of innovation? And specifically speaking about, say, someone like an Apple, where we've not seen too much innovation come out of, or they've not showcased too much innovation. How do you think some of these businesses would pan out over the next 4 or 5 years, given the fact they're heavyweights on passive indices?
Yeah, well, that's the opportunity for active investing. And so, for example, Apple, as you said, is a company that we sold out of the portfolio in October of last year. The reason we sold it is because it was expensive relative to the growth that we projected over the next 10 years, even giving them the benefit of some positive cycles. So it assumed growth on the top line on a CAGR basis of over 10%, which is a number that Apple has struggled to achieve just in the last few years. What made the sell even easier is the fact that Apple has trailed far behind every other hyperscaler in AI investments. Each year, they spend around $10 billion on CapEx. Most of that is going to retail, brick and mortar, building Apple stores, essentially. And only about $2 billion is going towards servers and data centers. Compare that to Meta, who's going to spend close to $50 billion this year. Microsoft over $50 billion, Amazon over $50 billion, Alphabet near $50 billion. This is a point in time where owning the infrastructure, understanding how it works, is a competitive advantage, and Apple doesn't have that. So I still think back to my 2015 discovery of GPUs, Siri still sucks. And it sucks because Apple hasn't invested in its AI infrastructure or machine learning or natural language processing. They've relied on others, just as they're doing now. Their Worldwide Developer Conference showed these little, small magic tricks of using AI, with whether it's in like using your calendar and incorporating it into messages, understanding a little bit more about who you are, what you have planned for your day. But all the heavy lifting is coming from a partnership with OpenAI. Right? They're going to build OpenAI into a massive competitor that's eventually going to threaten their own company. And what I think is really interesting is that everybody saw that and they said, oh, Apple's going to have a super cycle because only certain hardware is going to be able to perform these AI magic tricks. That's not true. The OpenAI ChatGPT app, they had their own showcase this spring, and it was on every single Apple device that they showcased on over the last 4 years, including legacy hardware like the iPhone 10, and it worked seamlessly. The magic trick from OpenAI was that they brought latency down and they humanized it so that ChatGPT was able to understand, if you were in a humorous mood or you're sad. It was able to incorporate its own humor and its own emotions into its voice. That is what's going to make the assistant, whether it's OpenAI's or Google's, and the one I'm really excited about is Meta's. That is what it's going to make this magic trick. That is what is going to turn this magic trick into something that will proliferate all of our consumer lives in a very, very big way. So Apple, we sold because they showed no AI sophistication and it was expensive. The companies that we own at the top are like NVIDIA and Meta. We own them in 5%, type of positions. And the reason we do is because they're at the tip of the spear with AI. They understand the platform shift that's happening, or they're leading the platform shift with much more sophistication, which gives them much more optionality and a much higher growth rate for a longer duration. Our ability, though, to make a lot of money for our investors isn't in saying like these are going to be the two that are going to be doubles and triples, or it's finding those other companies. It's finding NVIDIA before it's NVIDIA, or Tesla before it's NVIDIA, or Shopify, or Trade Desk, or Credo. The list goes on in terms of smaller cap companies or mid cap companies that turn into large cap companies, and it happens all the time. But all of our focus and attention only goes towards the mega cap names for some reason. And I don't think that's right. And I don't think that's the way to generate, huge alpha returns over the long term. So our belief is that, just as I showed earlier in the slides, is as we go through these different waves of innovation, leadership changes. So there is a chance, and this happens also in 10-year periods, when we look back in 2030, Apple might not be one of the top 10 largest companies in the world. But nobody sees this today because it's so hard to believe. But that's what has happened over many other previous generations.
Makes absolute sense. In fact, your point on reduction of latency and showing some bit of emotion or AI connecting with human emotion is something that will probably put AI into the next level of human interaction. Having said that, returns play an important part in terms of human emotion. And going to the results of the US Technology Fund, you can see it up on your screen. What most people will see it is that the last 1 year has been spectacular. But take a look at 5-year and 10-year returns. It's the funds compounded over 20% over a 5-year, 10-year period. And that's where, Joe, I want to get you back in, that we've had a stellar 2023. But we had a bit of a shock in 2022, which is the natural course of the market. How do you see this panning out over the next 3-5 years in terms of return specifications for the fund?
Yeah, I mean, especially right now, given the pullback that we've had, I would have said this even a month ago. I'm more excited for the next, 3-5 years than I've ever been. And I'm even more excited now, given, more of the skepticism that comes into the market. I think it's points in time like this where people oftentimes look for a new leadership in the market. Like what will lead for the next 10 years? The reality is that technology is and will be that lead.
Yeah.
I think forever, right? Like there's a reason why technology has crept up to, 50 or 60% of major indexes. And that's because we're so much more reliant in it. And so, I think we debate very often like, oh, tech is in a bubble or technology is dead. Like, I feels like we're either in one, if you read the news, it always feels like we were in one of the or two of those states. The reality is we just think about our own consumption and our own utilization of technology, and it's a much steadier trend that just works in a linear fashion and goes up. We use more tech today than we used yesterday. Now, comparing those 2 days, you can't feel it, but it's true. And you use more tech today for sure, and it's more obvious than a year ago or 5 years ago or 10 years ago. That's the trend that continues. But as that continues with AI, our opportunity broadens out. And so that means we will own more companies that are tech companies that are innovators, whether it's in energy or financials or healthcare or consumer. Like, that will happen. It's already happening. It's going to happen at a faster pace. And so we have to think today, like you're always playing against somebody, right? And so when the rest of the market is skeptical, that is a great opportunity to kind of baseline yourselves and have that, like that realization. And the real realization here is that technology isn't a sector bet. It's a secular bet that is eventually every fund will be a tech fund, because you won't want to own a company that isn't innovating with tech as their on a first principles basis. That's the reality, right? That's why even Jamie Dimon at JP Morgan, 5 years ago was saying we have to think like a tech company, because he was worried about Square, for example, or Stripe, or any of the de novo banks that had started up. But every single CEO was thinking that 5 years ago. And you're starting to actually now start to see that take hold. And we will see some legacy companies that are able to convert to this tech first foundation. But a lot of the opportunities that we're going to see are these ones that just start with a brand new mindset. And they're going to be tech first, tech enabled, tech platform, most likely AI platform. They're going to lead the way to higher returns, market share, and opportunity. And that's where I think I look at our 5 and 10 and think 20%. I think that's a very true reality going forward over the next 10 years, and maybe even better. We'll see.
I agree. I think we're in the third wave of technology. The first wave was when we were just using tech for emails or searches. The second wave was where we started using tech for watching videos and a lot of software. But I think we're in the third wave of tech, which is AI. And what we've seen is companies and returns from those companies keep getting bigger with each wave. And I think this one will be bigger than the previous two. I acknowledge that completely. On that note, I think we've spoken enough. Let's open it up for Q&A. I've got a bunch of questions, Joe, that I've lined up, but I will encourage people to put their questions on the chat window so that as you put them up, they will keep coming to me and I can keep asking Joe some of those interesting questions. So, Joe, the first one is a very obvious one, which is we're at that inflection point where the Fed is thinking about or dilly-dallying in terms of cutting interest rates. And we're probably going to see some happening soon, is what you also mentioned. But how does that augment for earnings of technology companies, and especially companies that are, attuned more towards the rate cycle?
Yeah, I think that you have to. I think it's a much larger benefit to smaller and mid-sized companies, because oftentimes it's smaller and mid-cap companies that are selling to small and mid-sized businesses. And they've been the most hurt from a high rate environment. And so as rates go down, they feel more confident in taking loans out, investing in their company, updating their systems or digitizing their systems. So that's really good for SMB exposed names. Examples of companies that benefit from that would be names like HubSpot, which we own in the portfolio. Have owned it for a very long time. I think Adobe, Intuit are also two names that will do very well in that environment on the software side. But it also encourages more larger infrastructure projects as well too. When you have a volatile rate environment, one that's going up, it is prohibitive for anybody planning large infrastructure projects, maybe that's a solar project, for example, it is very difficult to plan against, that unknown rate, in the future. It's much easier to plan over a 5 and 10-year period where you've now peaked and now you're going lower. That gives you more confidence that at least rates will not go higher, and most likely they go lower. And I think that's the opportunity for us on the infrastructure side as well, whether that's in data centers which would be very good for semiconductors and semi-cap equipment and foundries. But it's also going to be really good for energy projects as well too. So First Solar is the name that we've been building up our position. And then we two recent companies that we've looked at on the fund. Manhattan Software is one. The other one is Guidewire. They sell into retail and sell into insurance. Insurance has been hit really hard by a high inflation, high rate environment. They all just took pricing in the last year, and now you have almost you have negative inflation. And that's a really great opportunity for insurance companies then to invest in updating their system. So it's something that we think a lot about. But I think most importantly, it's just this mindset of risk on from an investor standpoint of saying like, hey, these smaller cap companies or mid cap companies that weren't very profitable and had really high growth and maybe didn't have a lot of cash on the balance sheet, we can take a little bit more risk. And that's where we're going to do, I think, wonderful in, especially relative to any of the passive indexes.
Fantastic. I think let's jump to the next one. The next question is around valuations of the portfolio and the earnings. Now, on your screen, what you can see is the portfolio characteristics. And the 1 year forward price to earnings stacks at a 28 multiple. The EPS growth 1 year forward is 27%. The question here, Joe, is with the cutting of interest rates, do you see a significant upgrade in EPS growth from a 1 year standpoint, or do you see this stagnating where it is?
Yeah, no, I think there's an opportunity for it to achieve even higher rates. That depends, I think, somewhat on rates of growth. And I think that's dependent very much on the economy and where we settle. So I don't think it will become clear for the next few months, and we will have volatility. We're in the U.S. We're going through an election. We're going through a change in the rate environment. But what I think is really important is that the footprint of what we own with a 28%, 28 times multiple with 27% earnings growth, that's almost a 1-for-1. Okay, so now look at the benchmark. You're paying 22 times earnings and you have half the growth, right? So you're almost paying twice as much for the benchmark as you would for our portfolio. And this is it's just a forward expectation, but this is something that encapsulates growth in a much better way over a longer period of time. This is how we make money, right? We buy higher growth companies, high quality companies that will sustain that growth rate. And we only pay a slight premium to do that in this environment. That's how you make money. Like the expectations are obviously low for a lot of these companies, and that's why you have a lower multiple. So that's a great environment for us.
Joe, in this current environment where clearly it looks like the U.S. growth is slowing down, but may not be a hard landing. You're also seeing some bit of leading indicators like PMI and employment data cooling off. Do you think the next 6 months can be a period where there can be a sharp sell-off in tech companies? And is that a great entry point for investors to come in?
I think as I said, we just had a almost 6% correction.
Yeah.
In the last, call it 2 weeks, 3 weeks. I think that's a great entry point. On average, over the last 20 years of looking at the NASDAQ relative to the S&P, when you have these corrections, you buy them because the regime change isn't happening. It never has. And every one of those points in times, everybody looks for it. This is the opportunity right now. It's why I invested in my own portfolio, 2 days ago, was because this opportunity, they don't happen very often. And I'm thinking over, past election cycle. I'm thinking, past the rate environment. Over the long term, over the next 3, 5, 10 years, these are the points in time where you buy tech or you buy those asset managers who have shown good performance and have been good stewards of capital. I think that's what we've done. I hope and learn, I hope that we've learned every year along the way on how to get better, which means in a bull market, we'll perform better. It also means in a bear market, we'll perform better. And that's what you get with somebody that has experience as well, like I do and like my team does, is that every market that we see helps inform our abilities to navigate, different environments. And so we're getting better. And I think that is, again, going back to my view over the next 10 years, that's why I'm so excited, is because I feel like we've learned so much just in the last 4 years, right? Going through COVID, going through the COVID digestion, going through the AI run that we're in right now, and then going even through this most recent pullback where I think we've operated very well relative to our peers also. So I think that's, that's what makes me so excited from this point.
Fantastic, Joe. I'm going to ask you one last question before I let you go, which is, what is one key message that you'd like to leave investors who are looking to invest in technology and technology-related companies with?
I'll give you 2 messages. Over the last 10 years, our portfolio is returned 523%. And if we compare that to the QQQs, we've done far better than their 411% return. Active managers are very important, especially in points in time like this, coming out of a very narrow market, which is obviously broadening. That's happening. The second one is the same message that I said before. Technology isn't a sector bet, it's secular. That means it's across every single industry. Every portfolio in the future is going to eventually be a tech portfolio, because all of their holdings are going to be companies that are benefiting from technology. So own that today, and you don't have to transition then in the future to the best ones. We are one of the leaders within, from a performance perspective, over a 5, 10, 20-year basis. We're within we benefit from the breadth of JP Morgan. So, well, we're really good at covering tech. I might not be as specialized on the healthcare side, but we have 5 other healthcare analysts and portfolio managers that sit, steps away from me, where we collaborate and share ideas, just like we did with the industrial teams when we were talking about Tesla or Rockwell Automation or First Solar or Enphase. So you get the breadth and the benefit of this internal skill set that has all these same characteristics that I talked about, whether it's curiosity and creativity and collaboration. And then you also get the benefit of JP Morgan's ability to be able to pick up the phone and ask Alphabet or Google to send it if we could sit down and talk to somebody about AI before AI is even in the minds of, any of other investors. And so finding those leaders today that will be the leaders in the future is really important. You don't want to just overload a portfolio full of the leaders today, because that's going to turn over. I think investors that do that might be disappointed.
Brilliant, Joe. It was super interesting listening to your insights today. For all of our distributors who've been on the call, I'm sure you guys enjoyed it as well. If you've got further follow-up questions or you need more collaterals, data, etc., please reach out to your respective relationship managers. we sign off today, and thank you so much for joining in.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.